Guys, today's video is going to be a little different. There is a serious thing happening in our country right now. Ordinarily, I don't comment on things like this, especially when it's early on in the process, but the collapse of one of the top 20 banks in the United States is something that's important because it gives us oddly familiar vibes from the global financial crisis 15 years ago. And I know we're going to have a lot of questions. In fact, we're addressing our own clients later this week, and so I wanted to take just a few moments and talk to you about how this happened, some of the frequent questions we're already getting, and most importantly, what are some lessons that you can learn from the situation? Understandably, people are very worried and loaded with questions, so I'm going to do my best to try and give you some good pointers and answer some of the questions you might have. So let's talk about how this happened. At a very high level, Silicon Valley Bank's been around for 4 decades or so, and they were among the top 20 banks in the US. And a lot of their clients as technology firms had a ton of cash that they just deposited into the bank. Well, how do banks make money? They take the deposits that their clients make and then they lend it out to other people, they invest it for their own capital purposes. This is the core business model for a large financial organization like this. Now, one of the investments that they chose was a 10-year treasury, where ordinarily treasuries are supposed to be safe, right? Well, this was paying 1.5% in yield or so on average. Then the interest rate environment began to rise, and the wrecking ball, that is the Fed's inflation hikes, has finally hit this bank. If you'll remember in some of our other videos, we talk about how interest rates that are rising causes bonds to go down in value. There is an inverse relationship, like a seesaw, like we've discussed before. So that means that the 10-year bonds that this bank purchased, as rates went up, the value of these bonds started to go down. And now, because cash was getting more expensive, companies weren't borrowing as much and they were using the cash that they had deposited. Well, like most banks, they don't have all of the deposits to give back to people because they've lent it out, they were investing it themselves. So they were forced to start liquidating some of those investments at massive losses. Now, to help also raise some more cash, they began to announce they were doing capital raising. So this is when they're looking for more investor capital. As such, many venture capitalists and other institutions started warning their clients and saying, hey, get your money out of SVB and park your money somewhere else. And so that started the classic run on the bank where everybody goes to the bank and starts to take their money out, and the bank doesn't have cash anymore to pay out their clients. And SVB lost around $40 billion in market capitalization, and so financial regulators came in and took over shortly thereafter. And it's interesting because as recently as a couple of weeks ago, they asked the CEO whether he felt there was risk in those long-term bonds that he had. So we're going to get to the FAQ towards the end, but first I want to talk about some really important lessons that federal employees need to learn from this. The first thing is make sure you understand FDIC insurance. It covers cash accounts up to $250,000. This does not include investments. Some banks can increase that by having agreements with other financial institutions. The second thing is if you do have extra cash above those limits, a lot of people are holding a lot more cash these days, make sure you talk to your bank and understand what the insurance coverage is for any of those additional sums. You should also have a high-level understanding of how your bank is running their balance sheets. What kinds of investments are they doing? These are things that are kind of difficult to find out, but you can find out if you look. And third, and this is the most important, choose your financial institutions carefully. You need to have a good understanding of how those financial institutions that you choose are doing business. One of the things that we do for our retirement clients is we do a massive due diligence process on the custodian of their assets. Over the years, one of the many deal breakers on this has been how custodians treat client assets. Very few of them are federally regulated as limited purpose savings trusts. Private trust companies are completely unique in that they do not commingle client assets with their own assets. This is one of the main reasons that SVB collapsed. Traditional financial firms make money by lending out your money, by taking your money and investing it, and they're using those assets that you put in as collateral for those loans and for those investments. It sounds heinous, but this is how banks make their money. Private trust companies adhere to federally mandated designs and controls to prevent fraudulent and unsafe activities. They're subject to all kinds of audits and examinations from the Office of the Comptroller of Currency or the OCC, and they can't participate in lending client assets out. By design, they're not pledging, lending, borrowing, doing margin on any of those assets. And also, as mentioned earlier, their client assets are not commingled with their own balance sheet. So with all of these systems in place, they're not subject to nearly the same kinds of risks as traditional brokerage accounts like SVB or Merrill or Schwab or Fidelity or any of those similar. And this distinct custody relationship keeps your assets aside in trust in your name to protect them from just this very kind of issue. And so more and more private wealth firms like ours are looking for private trust companies for the custodian of client assets, because this type of relationship is imperative when you've retired and you have to safeguard your wealth. And so I encourage federal employees to do the same kind of due diligence. I'm not telling you exactly that this is what you need to do with your assets, but I want you to be informed about what's out there so that you can make the best choice for your family. The point is to not be complacent in where you're choosing your custodianship. Understand how it is that they're doing business, how are they using your money, whether they're lending it to other people. Okay, so let's hit some FAQs. The big one is, what's next after this? Well, regulators have taken over the bank at this point, and so the FDIC insurance is going to kick in for anything under $250,000. I don't really see federal intervention here. It's going to be a little tricky. There were changes that happened since the financial crisis of 2008 that allow the government to come in over systemic issues, not individual ones like this. It's likely that other big banks are going to come swoop in and probably pick up whatever's left over. The next one we get, will other banks be affected? Yes, in varying degrees. And so I think some of the smaller banks have a bigger risk, especially if they are also similarly invested and have the same type of clientele as SVB. In general, the larger global banks will really have enough capital and cash flow to be able to deal with this. But their stock prices are most certainly going to be impacted to some degree. In fact, if you look at Schwab, I think they're down something like 27% or around that figure over the last month. So the Federal Reserve is going to keep a pretty close eye to make sure that there's not spillover. The next one we've gotten, is this going to bleed into other areas? Possibly. It's still really early to make a judgment call. You know, this kind of thing could set a ripple effect, but I don't necessarily view it currently as a risk given how isolated this was. Notably, commercial real estate has a similar capacity problem, especially since COVID and corporations have all really moved to kind of hybrid or totally remote. And the biggest one, should we be worried? Honestly, at this point, I don't think there's a reason to be extremely worried unless you were directly impacted by the situation with Silicon Valley Bank. Right now, there's little risk to the system itself. This was a pretty isolated issue for a very specific reason, but it brings forth some interesting questions that investors need to be asking. News like this is always very challenging because the trauma from 2008 is pretty much permanent. And so you should use this as a learning moment to gain greater perspective and have a greater understanding of how financial markets and institutions work. So I hope this was helpful. If you found this at all helpful, give us a thumbs up and let us know. And make sure you tune in next weekend for our other video coming out soon. We hope to see you next time. Until then, stay wise and stay wealthy.